Welcome to Breaking News to Trading Moves. So imagine you just bought a state-of-the-art sports car,
Okay, I like where this is going.
right? And the engine is just an absolute marvel of engineering. It's capable of mind-bending speeds. But there's a catch.
There usually is.
Yeah, the fuel line feeding that engine is basically the size of a standard plastic coffee straw.
Oh, wow. Yeah, that's a problem.
Exactly. Because it really doesn't matter how powerful the engine is, right? It's going to stall out because it simply cannot pull in fuel fast enough.
Right, it's choking on its own potential.
Yes. And if you can picture that frustrating bottleneck, you basically understand the biggest hurdle in artificial intelligence hardware today. And that brings us to the exact news item we are looking at for you right now.
Yeah, it's a really compelling one.
We are looking at the headline, the SK Hynix Pivot, Navigating the AI Memory Ecosystem.
Which is such a perfect focal point, by the way. It really helps you understand how one specific manufacturing update alters the math for entire portfolios across the market.
It really does. So we have a very clear mission today. We are going to map out the exact path from this SK Hynix headline directly to the winners and losers. But first, let's establish the ground truth of what actually happened.
Right, let's get the facts straight.
So SK Hynix is a massive player in the global memory market. And they recently had a very strong Nasdaq debut for their U.S.-listed American depository receipts.
There was a lot of excitement around that, a lot of hype.
Tons of excitement. But then, almost immediately following that debut, the company's Seoul-listed shares took a rather sharp fall.
Yeah, they really did.
Traders stepped in, locked in their profits, and basically began reassessing their expectations for SK Hynix's upcoming shipments of HBM4.
Which is the crucial detail here.
Right. So before we start naming companies and sorting them into winners and losers, I think we need to clarify the core technology for you. What exactly is HBM and, why does a reassessment of its shipments command so much attention on Wall Street?
Yeah, so HBM stands for high bandwidth memory. And to grasp why it matters so much, let's go back to your sports car analogy.
Okay.
In the AI world, the engine is the AI accelerator, or the GPU.
Right.
It is the brain performing all the complex mathematical equations required for machine learning.
And it does that incredibly fast.
Unbelievably fast. But standard memory simply cannot feed data to it fast enough. It creates that exact coffee straw bottleneck you described.
Right. The data is just bottlenecked.
Exactly. So HBM was invented to solve this. It is a highly specialized, highly complex memory architecture, and it's designed specifically to move massive volumes of data at just blinding speeds.
So it's like instead of having a library situated 3 towns over where you have to wait for a delivery truck to bring you a book,
Right.
HBM is basically like putting the library directly inside the brain's skull. The data is just available instantly.
That is a highly accurate way to look at it, actually. It is all about proximity and bandwidth. And because it's so utterly essential for these advanced AI chips to function correctly, any change in HBM supply or pricing or demand, it immediately impacts the entire hardware ecosystem.
Which means a lot of moving parts.
Tons of moving parts. We are talking about the memory producers, the equipment suppliers, the companies designing the chips, and even the major cloud providers buying the final servers.
Which gives us a very clean, logical path to follow today. Let's move right into our first group, the companies benefiting from the struggle.
The winners?
Right, the winners.
Yeah.
Because it stands to reason that if one major supplier like SK Hynix faces questions about its ability to hit shipment targets, the customers are not just going to sit on their hands.
No, absolutely not. They can't afford to.
Right. They will actively look elsewhere to fill that void.
Exactly. When the leading provider faces a potential delay, the spotlight immediately turns to the alternatives on the market.
And the most obvious potential winner here is Micron Technology, MU.
Yes. Micron is the clearest beneficiary you can point to right now. I mean, they compete directly in advanced memory, and they are a major player in HBM specifically.
So they're positioned perfectly.
They really are. Because if the shipment reassessments we are seeing with SK Hynix turn out to be strictly specific to their own internal manufacturing,
Meaning it's an SK Hynix problem, not an industry problem.
exactly. If it's just an SK Hynix problem, not a broader industry slowdown, customers are going to desperately need to secure that memory supply somewhere else. And they are highly likely to seek more supply from Micron.
Which gives Micron a lot of power.
It hands Micron a much stronger market position and crucially gives them a lot more leverage to dictate pricing.
Yeah, that makes sense. Now, we also have SanDisk on this side of the ledger, SNDK.
Right.
But looking at their product lines, They are not a direct rival in the highly specialized HBM space. So why do they end up in the winner's circle based on an SK Hynix headline?
That is a great question. It really comes down to how capital rotates within the financial markets.
Okay, what do you mean by that?
Well, SanDisk offers broad exposure to the general memory and storage cycle. And in trading, you frequently see portfolio managers rotate their capital rather than completely exiting a sector.
Oh, I see.
So if money is flowing out of SK Hynix because of these specific HBM4 production concerns, those traders might still want their portfolios exposed to the broader memory market.
So they just move the money over to SanDisk.
Exactly. They might rotate those funds directly into a name like SanDisk, catching the wider industry momentum while completely avoiding the specific manufacturing risks currently tied to SK Hynix.
Okay, I have to jump in here and play devil's advocate for a second, just to make sure we are giving you the complete picture.
Go for it.
When we talk about these massive tech companies seeking supply from an alternative like Micron, I imagine it is not easy. Like, is switching memory suppliers really as simple as taking one brand of AA battery out of a remote control and snapping in a different brand?
No, not at all.
Like, how quickly can a company actually pivot away from SK Hynix over to Micron?
I am really glad you brought that up because it is a vital distinction. It is absolutely nothing like swapping out AA batteries.
Okay, so how rigid is it?
These supply chains are incredibly rigid and deeply integrated. I mean, HBM is often co-designed, or at the very least, rigorously qualified to work flawlessly with one specific AI processor from one specific designer.
So they are built for each other.
Exactly. A customer cannot just flip a switch on a Tuesday afternoon and start running Micron memory on a Wednesday morning.
Right.
The qualification process alone involves testing across different temperatures, different workloads, error rates, and that takes months.
Wow. So they are essentially locked in for the short term.
Physically, yes, they are locked in. However, the stock market is a forward-looking mechanism. If SK Hynix is facing a potential 6-month delay on HBM4, customers will immediately begin drafting contracts and initiating that lengthy qualification process with Micron today.
I get it. So the market prices in that future revenue.
And that future pricing power, exactly. The moment the news breaks, well before the first physical chip never actually changes hands.
That makes total sense. Wall Street is trading on the reality of those future contracts being signed today.
Precisely.
So let's trace the supply chain back a step and look at our next group, the pick and shovel providers.
Yeah, this is a fascinating part of the market.
Because if HBM4 is proving difficult to manufacture and those shipment expectations are dropping, memory producers are going to have to spend a lot of capital and resources to fix their factory floors.
It is a classic dynamic and complex manufacturing. When the final product becomes stubbornly difficult to produce, the companies selling the specialized tools to make it become highly valuable.
And the winners in this category are the companies providing the extremely complex machinery required to build advanced DRAM and HBM.
Right.
We are looking at Applied Materials, AMAT, which handles materials engineering systems. We have Lam Research, LRCX, providing etch and deposition tools, and KLA Corporation, KLAC, which supplies the inspection equipment.
Yep, the big three tool makers.
So walk us through the actual factory floor here. Why does a difficult manufacturing process directly boost these specific tool makers?
Well, to understand this, you have to realize that building high bandwidth memory is a microscopic balancing act.
Okay.
You are not just laying memory chips side by side, you are literally stacking them on top of one another like floors in a skyscraper.
Literally stacking them up.
Yes. And to get them to communicate, you have to drill microscopic vertical channels right through the silicon to connect the floors.
Wow, that sounds incredibly precise.
It is. If those channels do not align perfectly, or if heat dissipation is mismanaged, the entire stack is just ruined. So when a company struggles with HBM shipments, it generally means their yield is low.
And yield is basically the grading scale for a silicon wafer.
Right.
Like how many of the chips actually work versus how many end up in the trash.
Exactly. Yield is the percentage of perfectly functioning chips.
Yeah.
And if your yield is low, you are throwing away incredibly expensive raw materials.
Which nobody wants to do.
Right. So to fix a yield problem, you need to improve your fundamental processes. You need better materials engineering from Applied Materials.
Okay.
You need far more precise etch and deposition tools from Lam Research. These are the machines that literally carve out and fill in the microscopic circuitry on the silicon.
Right.
And perhaps most importantly, you need advanced inspection equipment from KLA to catch those microscopic defects early before you waste time assembling a broken chip.
So basically, an engineering struggle forces the memory producers to open their wallets and buy more advanced tools just to stay competitive.
That's exactly it.
But the equipment spending does not just stop at the silicon wafer itself, does it? There is another crucial category of winners here: the packaging and testing companies.
Oh, absolutely.
We are talking about M-Core Technology, AMKR, Teradyne, TER, and Onto Innovation, ONTO.
Yes, packaging and testing are paramount in the AI hardware ecosystem because, HBM cannot just be plugged into a standard motherboard slot like the memory in your home computer. Well, because it needs to move data so incredibly fast, it must be packaged right alongside the AI processor itself, usually on the exact same piece of silicon substrate called an interposer.
I have heard this described as them being roommates, sharing a very tiny apartment. But from what you were saying, it sounds a lot more permanent than that.
It is much more permanent. A better way to picture it is that they are surgically grafted together.
Oh, wow. Surgically grafted.
Well, yeah, they share a central nervous system. And because they are permanently bonded, the testing protocols must be absolutely flawless.
There's no going back.
Exactly. Imagine taking a memory chip that costs a couple $100 and permanently gluing it to a highly sought-after AI GPU that costs $30,000.
Yikes. So if the memory chip turns out to be a dud after the glue dries, you can't just peel it off.
Precisely. You have just destroyed a $30,000 piece of hardware.
That is a massive loss.
It is catastrophic for margins. Therefore, as HBM becomes more complex and harder to manufacture reliably, memory companies have no choice but to spend heavily on automated testing and inspection technologies provided by Amkor, Teradyne, and Onto Innovation.
So production challenges directly translate into a massive budget increase for quality control.
Exactly.
All right, well, we have thoroughly covered the companies benefiting from the struggle. Now we need to flip the coin and look at the other side of the ledger. Let's move to the direct hits and the high beta sympathy drops.
Right, the losers in this scenario.
Because while the toolmakers win when manufacturing gets difficult, the companies carrying extremely high market expectations faces severe penalty when those expectations are even slightly questioned.
This is where we start to see the immediate, visceral market reaction to the headline.
Right. And the direct loser in this scenario is obviously SK Hynix itself, SKHY. Investors holding that stock are now forced to make a very tough decision. Did that initial incredibly strong Nasdaq debut reflect durable, long-term commercial demand, or was it simply excessive, unchecked excitement around the entire AI memory narrative?
It forces a harsh reality check, because when a stock is priced for absolute perfection, any news about reassessing shipment targets shatters that illusion of perfection.
The momentum just breaks.
The momentum breaks. Traders who bought in early will take their profits off the table and step back to reevaluate the actual underlying fundamentals of the business.
But the selling does not just stop with SK Hynix, does it?
No, it rarely does.
Because when reviewing the wider market reaction, you see companies like Astrolabs, ALAB, and Credo Technology, CRDO, taking a hit as well.
Yeah.
And I look at Astrolabs and Credo, and neither of them competes with SK Hynix directly in the memory market.
Yeah.
So why on earth are they taking collateral damage?
Because they fall into a category we call high beta, high growth AI infrastructure stocks.
Okay, break that down for us.
So high beta is a financial term that basically means a stock is more volatile than the broader market average. They move very fast in both directions.
Up and down.
Up and down. And in the technology sector, companies are frequently grouped together by a shared narrative. When a major, highly visible player in the AI hardware space like SK Hynix experiences a sharp reversal, it spooks the trading desks.
You know, I like to compare this dynamic to a cooling real estate market.
Okay, let's hear it.
Imagine you live in a very desirable, hot neighborhood. For the last year, every single house has been selling for way above the asking price.
Right, a total seller's market.
Exactly. Then the premier house on the block, the massive one with the pool and the custom guest house, it goes on the market and it just sits there. It does not get a single offer at its asking price. Suddenly, buyers start questioning the valuations of every single house in that zip code, even if they are looking at a modest 3-bedroom ranch that has absolutely nothing in common with the mansion.
That is an excellent way to visualize the psychology at play here. Traders see SK Hynix stumble, and they immediately look at their own holdings and ask, wait, Am I exposed to too much risk across this entire AI infrastructure theme?
They just want to de-risk.
Right. They start selling off shares of Astera Labs and Credo Technology, not because those specific businesses reported bad earnings or failed at a product launch, but simply to reduce their overall exposure to expensive semiconductor names.
So it is a classic sympathy drop driven entirely by sector-wide risk management.
Exactly.
Okay, let's follow this supply chain further downstream to the next group, the chip designers. As we established earlier, memory does not work in isolation. It must be paired with those processors.
They need each other.
Right. So if the memory shipments are constrained or delayed, the designers building the actual AI chips face an immediate physical bottleneck.
The designers can dream up the most advanced architectures in the world, but they are entirely at the mercy of the physical reality of the supply chain.
And the potential losers in this downstream category are the real heavyweights of the industry. We are looking at NVIDIA, NVDA, Advanced Micro Devices, AMD, and Broadcom, AVGO.
Yeah, these are the giants. And NVIDIA and AMD rely heavily on HBM for their flagship AI accelerators. Without that specific type of memory, their processors literally cannot function at the advertised speeds required for training large language models.
I'm Broadcom.
Broadcom finds itself in a very similar position with their custom AI chip programs, which also depend on securing advanced memory to meet their specific clients' rigid demands.
So when you look closely at the dynamics here, there's actually a dual risk for these designers. There are two entirely different scenarios for why HBM4 shipments might be reassessed by SK Hynix, and the implications for a company like NVIDIA change drastically depending on which scenario is true.
This is critical to understand.
Walk us through the first scenario.
Well, the first scenario is a straightforward supply issue. This means SK Hynix simply cannot manufacture enough HBM4 chips to fulfill the orders they have on the books.
Like their yield is low or their factory lines are stretched.
Exactly. If weaker shipments reflect those manufacturing constraints, then designers like NVIDIA and AMD face a very tight supply environment.
Which means prices go up.
Yes. They will likely have to pay much higher input costs to secure whatever memory is available, which eats directly into their profit margins. Or worse, they face actual product delays, meaning they cannot physically ship their finished AI accelerators to their customers on time.
Okay, so that is a pure bottleneck scenario.
Yeah.
The designers want the memory, their customers want the final chips, but the factory just cannot spit them out fast enough.
Right.
But what is the second scenario?
The second scenario is a demand issue, and this is the one that makes the broader market incredibly nervous.
Why is that?
Because what if the weaker shipment expectations from SK Hynix actually reflect softer demand from the chip designers themselves? What if NVIDIA or AMD are simply not ordering as much memory as Wall Street expected them to?
Oh, so investors might view this as a canary in the coal mine.
Exactly.
Because if NVIDIA is ordering less memory, that directly implies they expect to sell fewer finished GPUs.
Precisely. It implies they are anticipating a slowdown in orders from their own customers. That takes a localized, company-specific manufacturing story in Seoul and suddenly morphs it into a macroeconomic tech narrative about the durability of the entire AI boom.
Wow. Which perfectly sets up our final group.
Hmm.
We are moving from the companies designing the chips to the massive organizations actually buying all this finished hardware to build out global data centers.
Oh, hyperscaler.
The hyperscalers, the ultimate end user sitting at the very top of this entire multi-billion-dollar supply chain.
Yes.
And the potential losers at this final stage are the largest cloud computing companies on the planet. Alphabet, GOGL, Microsoft, MSFT, Amazon, AMZN, and Meta Platforms, META.
The titans of tech.
Truly. These hyperscalers are spending heavily on AI data centers and accelerators right now. It is a historical capital expenditure cycle.
Oh, without a doubt. They are pouring tens of billions of dollars into physical infrastructure. They are building massive server farms to train larger models and to offer commercial AI services to their cloud computing clients.
So we have to weigh the potential outcomes for these tech giants based on that dual risk we just explored.
Right.
If this is just a supply issue limited HBM4 available because of SK Hynix manufacturing struggles, does this simply result in higher hardware costs and slower server deployments for Alphabet and Microsoft? Or does the market suspect a demand issue, where these cloud companies are purposefully moderating their capital expenditure budgets and placing weaker orders?
Honestly, that is the defining question for technology investors this quarter.
How so?
Well, if it is just a limited supply issue, the hyperscalers suffer from annoying logistical headaches and higher hardware costs.
Hmm.
The servers they need to construct their data centers become more expensive to build, and their deployment timelines get stretched out by a few
But
quarters.
that doesn't derail the whole train.
No, it definitely hurts their short-term ability to scale up their compute power, but the long-term investment thesis remains totally intact. They still want to buy, they just have to wait.
But if it is a demand issue,
If the disappointment is being driven by weaker orders from the hyperscalers themselves, it alters the math for the entire stock market. The street will immediately question whether these giants are finally moderating their massive AI capital expenditures.
right, like, are they pulling back?
Exactly. Are executives at these companies looking at the actual return on investment from these billion-dollar data centers and deciding to pace themselves? Because if Alphabet, Microsoft, Amazon, and Meta decide to slow down their spending, every single company in the AI hardware ecosystem will feel the financial pain.
It is really fascinating to trace that path. We started with a single memory supplier in Seoul adjusting their shipment expectations, and it leads straight to questions about the capital expenditure budgets of the largest, most powerful companies on Earth.
It's all connected.
It really is.
Yeah.
So let's quickly recap the territory we have covered for you today. We looked at the SK Hynix shipment reassessments and mapped the market into clear winners and losers.
Right.
The winners are the alternative memory providers like Micron and SanDisk, who are poised to capture market share or investor rotation. The winners also include the equipment makers and testing companies, Applied Materials, Lam Research, KLA, Amkor, Teradyne, and Onto Innovation, who actually profit when microscopic manufacturing gets difficult and requires more precise tools.
And on the flip side, the losers include SK Hynix dealing with the direct reality check on their valuation, alongside high beta sympathy drops in names like Astera Labs and Credo Technology.
Yep.
And most importantly, we mapped out the dual risks for the downstream buyers, the
Yeah.
chip designers like NVIDIA and AMD, and the cloud hyperscalers like Alphabet and Microsoft, who face either tighter hardware supply constraints or looming questions about their overall spending appetite.
It gives you a really complete logical map of the hardware ecosystem. As we wrap up this analysis, what is a final thought you can leave with the listener today? Something for them to mull over as they watch these particular stocks trade throughout the week.
I would suggest considering the long-term balance of costs in this specific supply chain.
Okay, tell us more.
We talked at length about how this struggle to manufacture advanced memory actually benefits the companies making the testing and inspection equipment, but think about the long-term trajectory of that dynamic.
Right, where does it end?
At what point does the ballooning cost of testing, inspection, and quality control actually outpace the economic value of the memory upgrade itself?
Oh, that's a great question.
If successfully making the next generation of memory requires so much expensive, time-consuming testing that the final product becomes financially unaffordable for downstream buyers like NVIDIA or Microsoft, the entire upgrade cycle could stall out. It is a highly delicate balance between pushing the absolute boundaries of physics and maintaining basic economic viability on the factory floor.
That is a very compelling angle to watch carefully as these manufacturing processes get increasingly microscopic and exponentially more expensive. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.